good morning. I am Shannon Reed with Montgomery Area Chamber of Commerce, and I'm delighted to kick off our MACC U series, our workshop series for 2020. And today I want to make an introduction to our guest speaker and presenter, and she's kind of spearheading our series this year. I'm excited about all of the things that are going to come.
Yes.
So we'll want to always come back, tune in, take another class, and it will all be posted on our website, Chambermaster, through our login. So we'll be able to go back and review and take some of these tips with us. All right, so I would like to say a huge thank you to Michelle Cannon here at RE/MACC Distinction. What a gorgeous space. Thank you so much. She is allowing us to be here hosting us today, so we're so appreciative of you. Thanks. And all that you have brought to the community. I mean, this is just a treasure, and you've taken good care of the historical buildings, so we love all of that. That's a great partner, so I appreciate you.
Thank you.
And with no further ado, let me introduce Kim Harris, and she is with Advanced. I almost said alternative. Advanced Retirement Planning. And she is an income specialist. Yes, so she is going to kick off our first workshop on tax tips to help your business be more profitable in 2020.
Yes,
Take
that's
it
right.
away.
Thank you
You're
so
welcome.
much, Shannon.
Okay.
And before I get started, I am going to turn this volume up.
Yes.
So when we get to that fun little clip there, you'll be able to hear it real well. Are we on back there?
Yes, ma'am.
Okay, well again, I want to thank Michelle Cannon for hosting us here at RE/MACC Distinction. And I'm Kim Harris. I want to introduce myself a little bit. I've been in financial services for 30 years. I'm currently licensed with the state of Oklahoma and Texas with my life accident and health license. I've done many things in financial services, but I really enjoy the strategic planning that I'm doing now with advanced retirement planning. I have people that I work with on a day-to-day basis. The founder of our company is Brian Byers. He has been in this business for over 25 years. He is top of the table of the $1 Million Roundtable, which is a very interesting and prestigious organization. He also belongs to the Forum 400. I also work hand in hand with David Tripp. He is our attorney on staff. He has his master's in taxation. And also with Jonathan Illig. He is known nationwide as the advisor to the advisors. So these are just three of the caring hearts and brilliant minds that I have the pleasure of doing business with every day. Some housekeeping, if y'all make sure that your phones are on silence. And at the end, we're going to open it up to questions. So I have put a paper here in front of you where you can make notes on your questions, and we'll be sure to get all of those answered at the end. But because of the recording and in respect for everybody's time, I would like to, just make note of your questions. So for the past 40 to 50 years, taxes have been pretty favorable for us, whether we've had Republican or Democratic leadership. And if you think about what we receive in lieu of paying taxes, taxes are really a good thing. We have fire protection, we have police protection, we have clean water, we have people to pick up our trash, and we have protection from foreign countries coming in to our neighborhoods and our homes. So as much as sometimes we hate to pay taxes, we do have some good benefits from them. But most of us can become extremely agitated when we think about paying taxes. And many times it goes back to what we, our thoughts and our opinions on how the legislatures spend our tax money. So here's just a little clip to get us started about
Where's all your money gone, buddy?
Taxes, 9, 10, 11. Let me fix my houses. It's okay. It's part of the game.
No, it's not fun.
It's not fun to what?
It's the worst part of the game.
is what? Taxes.
Isn't that precious? Oh, so in order to know where you're going, it's important to understand where you've come from. So we're going to spend this next segment in getting some perspective on where we've been and where we're going. You know, we as business owners are in a very unique position. Unlike W-2 employees, we have the opportunity to plan our business structure that will determine what we pay in taxes. So as we move into the next slide, what was the highest marginal tax rate in United States history? Does anybody know what it was, the highest percentage?
39.
No, that's low.
Oh, my goodness.
Yeah.
I was gonna say 30. Thinking,
No,
50.
no.
What?
Mm-mm.
75.
The highest was 94%.
Yeah.
And that was during
goodness.
World War II.
Okay.
So you can see here
Wow.
how high it was. And if you made over $200,000 a year, you paid 94% federal income tax. Now keep in mind that $200,000 then is the same as like $3 million today, okay? So someone that we're all familiar with, Ronald Reagan, was making movies during that time. He only made 2 movies a year because he made $100,000 for each movie. Because he didn't want to move into the 95% tax rate. So this is a graph showing the tax rate versus the national debt. And you can see here in the 40s where the taxes were the highest. And also our national debt was the lowest during World War II because we paid our way for the war with war bonds and the high taxes. Now you can see where the national debt started to increase in the 70s. That started during the Vietnam War. And then, I'm sorry, it wasn't a war, it was a conflict. So we have the Vietnam conflict, the Persian Gulf conflict, we have Afghanistan, Iraq, and Iran, and no longer have we paid our way for the wars, we borrowed for the wars. And so the national debt, that's one of the reasons the national debt has increased. Another reason that the national debt has increased is you see during the 60s where the tax rate was at 70%. During that time frame is when executives of companies, their salaries increased greatly during that time frame. They took the opportunity of their position in the world to speak to the politicians to get the taxes lower. So it was during that time frame that the 401ks came into existence. So, and for every dollar at that time that was put into a 401k, they saved 70 cents on every dollar because their money wasn't taxed until they drew it out for the required minimum distributions. Also in this time frame where you see our revenue going down, it's because of how corporations were taxed. Securities and Exchange Commission, for example, did a report for 2018. During that time, in their research and what they viewed on the taxes as large corporations have to turn in, corporations like Amazon and Netflix, who made billions of dollars, paid little or no taxes whatsoever, and they got refunds. So we're paying out instead of having those high dollar entities pay in to help with the national debt. The good news is that taxes are on sale until 2026. Does anybody know why taxes are on sale? It's because of the Tax Cut and Jobs Act of 2017. This year, when you're going to see, you know, our tax rates have dropped, but it's because of that. So you can have your cake and eat it too, and you can increase your bottom line because of that, and we have the ability to do some planning. So these are the new tax brackets. The rates, I don't know, can you see over to the left? Those are the marginal tax rates. So if you study this, you can see that people who make between $150,000 and $500,000 a year, we bear the highest tax burden. And many people, I've heard people say that, you know, well, we're paying 50% in taxes. Well, you might be if you live in New York or California, where, you know, there are high taxes there. But generally, you know, most of those people are making over $2 million, and there's tax strategies where, you know, they don't have to pay that 50%. So I talked to you about marginal tax rates. The other thing we hear about is the effective tax rate. So that's what you actually pay on your taxes, is your effective tax rate. So we're gonna look at $100,000 gross income because that's easy math. This is the tax rates for married filing jointly. Standardized deduction is the $24,800. So taxable income is $75,200. So you start with 10%, and on the first $19,750 of that taxable income, you pay 10%, which is $1,975. And in this example, then you would pay 12% tax on the remainder with $6,654, totaling $8,629, or 8.63% of $100,000 of gross income. So you're in the 12% tax bracket, but your effective tax rate is 8.63%. That's the difference, okay? And as you have your taxes prepared, there's always going to be a page that's going to show you your marginal tax rate and your effective tax rate. Now the bad news is the pain train is coming if you don't plan. I want you to think about the population as a whole in the United States. Let's take off the bottom 10%. They pay the least taxes. The top 10% pay the most. So those of us in here most likely are in that 80% bracket. Well, if you think back about when the 401k started, and they saved 70 cents on the dollar for everything they put in a 401k. So now a couple that makes about $150,000, they would be saving 25 cents on the dollar. All of us have been advised the thing to do is overfund your 401k. Well, think about it. If we're saving 25 cents on the dollar now, and we get to wait now until we're age 72 to take out required minimum distributions, economists are saying the taxes are going to go up. Most predict 50%. So is it good advice for us to save 25 cents on the dollar, and later we're going to be paying much more taxes when we draw it out? So the advice that we've all been given, the 80% of us, you know, we're all fishing out of the same pond, but that's what we're all being told. The best strategy is to overfund your 401k. Now, we need to rethink that strategy. So what's a 4-letter word that politicians do not like to talk about? Any guesses?
Save. No.
Debt.
Debt, no.
Right. They don't like to do that. Depending on what news channel you listen to, you're going to hear that America has, you know, 23 trillion up in debt. You know, hard numbers are the 23 trillion. So, what's another four-letter word that explains our real problem? And this is not an emotional word.
Well, I would say spend, but that's
Math. It's math. Because, basically for $23 trillion in debt, each one of our households are responsible for $400,000. So if we were to wipe out our national debt, I don't know about you, but I don't have $400,000 in my pocket just to write the federal government a check and say, here's my part in helping you clear this up. So this chart was put out by the Congressional Budget Office. The line down the middle to the left is the actual, to the right is the projected, and they are projecting the red line that we're going to continue. Our spending is going to go up. Our revenue is going to go up, but it still doesn't take care of our debt. So at some point, we're going to have to deal with that. And everybody is predicting the way they're going to deal with it is taxes are going higher. So what can you do? Up until this point, I've laid a foundation, a perspective, where we've been, where we are right now. So this is a segment that I encourage you to take notes, to be able to go back and talk to your tax person, your attorney, your financial planner, so that you can make good informed decisions for yourself. So I'll tell you a little story. I became acquainted not too long ago with Joseph Jordan. Joseph Jordan is an advocate for people to ask them the hard questions about what's the right thing for you to do for your family. And I'm going to tell you why he does that. In the 50s, his father was a predominant attorney in the New York area. He was an advisor to Harry Truman. He had 4 children. Joseph was the youngest, and a wife. They owned 3 properties. He had $100,000 cash value life insurance. He decided to cash in his policy to terminate it, and so he could buy another piece of property. Several months after he did that, anybody guess what happened? He died, right? So he left his family without any life insurance, nothing to fall back on. Overnight, they became destitute. Mom had to go to work, and she had no training whatsoever. The oldest daughter had just received a scholarship to go to college. So the 2 oldest daughters, Mom told them, you cannot go to college right now because you have to work and make money so the boys can go to college. So at that time, Joseph was 6 months old. So Joseph grew up in a home affected by the fact that there wasn't an advocate to talk to his dad to say, why are you doing that? You can't leave your family like that. So I hope that today I can be your advocate, and that I can ask you the hard questions that nobody likes to be asked. We have to talk about death because we're on a timetable. It's a cycle of life. Unfortunately, people spend more time planning their vacations than they do planning out the rest of their lives. And so I'm going to encourage you to take time to plan out your future. So what's your long-term goals? What's your long-term goals for your business? Work until retirement and then shut it down? Sell it? Pass it to your children or your family? How are you going to pay for it? These are some other questions that are really good to write down and to think about. What do you want your money to do for you while you are alive? What do you want your money to do for you when you are dead?
I'll be gone.
I know, you mean gone. What do you want it to do for your spouse? What do you want it to do for your children? What do you want it to do for your grandchildren? How can you protect your business and your retirement from your parents' health needs, from divorce, whether it be the owners of the business or children? And what if the spouse of one of your children wants a large sum of money and they want the divorce and they want to go after some of the money? How are you going to protect your business and retirement from that? And lastly, lawsuits. How are you protected from lawsuits? It all has to do with succession planning. What if you get sick? There was an agent who wrote a life insurance policy with living benefits on a lady. She's a single mom. She also took care of her parents. She arrived at work one day and she was violently attacked, almost lost her life. She was hanging in a limb for several months after this horrific accident. But because her agent was an awesome advocate, he wrote her a life insurance policy that had living benefits. So what that meant was that they were able to advance $425,000 of that $500,000 life insurance policy to put in the bank so she could continue her current lifestyle, continue to help her parents, and she could concentrate on getting better. That's something that can happen. That living benefits are, it's new, maybe in the last 2 or 3 years for life insurance policies, but it does help on situations like that and if you get sick. So do you have a plan if you get sick? What if your partner wants to sell the business? Do you have a plan in place to buy them out? The other thing is, what if the partner dies? Overnight you become you're in business with a grieving spouse or even children. Most business owners spend more time working in their business and not on their business. So many today are involved in do-it-yourself projects, but succession planning is one that you should not try to do yourself. Legal planning, tax planning is something you should not try to do yourself. Life's biggest expenses are taxes, and if you're not properly prepared, they can annihilate your income. Real key is to revisit your business structure. Your business structure affects how much you pay in taxes, your ability to raise money, the amount of paperwork that you're required to do. It's really important not to fear complexity in business structures. I'm going to give you some examples. So if you are a sole proprietor, maybe you should consider forming an LLC or starting an S-Corp, because there are some expenses and tax advantages to both of those that you have. Maybe you're a single member LLC or an S-Corp. You could add another member to that LLC. We had one client that did that, added his wife to the LLC. They were able to spread out the income, made their effective tax rate 6%. And then instead of investing in her 401k, they decided to use that money in another fashion that they felt comfortable with to invest in their money. If you have a lot of equipment or vehicles, separate LLC that owns the equipment and vehicles. So I want to give you an example of some clients we helped which are not in this state, okay? So you don't have to think about who they might be. But there were 2 guys that owned an exterminating company, been in business for 20 years. We sat down with them and talked to them. They were college roommates. Most important thing to them at that time was smoking pot and having fun. They worked part-time as an exterminator, so they would have money to do what they wanted to do, and then they finished their college. So when they graduated, they decided to go in partnership and start this business, which was very good. Their LLC had a tremendous amount of contracts from homeowners and business owners to do the exterminating for the homes and the businesses. They had 100 vehicles.
Wow.
And all was owned by the parent LLC. So when we sit down and work with people, we look at where's your risk, where's your liability at? Well, if one of those employees would have an accident and severely injure someone, everything within that LLC is at risk. So we started an additional LLC that owned all of those vehicles. They also owned 3 warehouses. We separated those out, put those in a different LLC for 2 reasons. One, for succession planning, for when they got ready to sell the business, the new owners may not want to buy those warehouses. The other reason we did it was for liability purposes. A good example for this is there was a community in the Atlanta, Georgia area, a pool company that had a chlorine leak. So there was a chlorine cloud, and businesses had to be shut down, families had to be evacuated. So after it was all cleaned up, what happened? They sued, lots of lawsuits. Okay, so separating this into, putting those warehouses into a different LLC protected their main company. So again, my point, as we set up here, don't fear the complexity. And this is really crucial. Be sure that you're tracking all the expenses that qualify for deductions. And we're going to go over a few, and this is something that you need to work very closely with your tax person. Vehicle expenses, 58 cents per mile. So, coming here to this meeting, 58 cents a mile. But if you get audited, the IRS is going to want to see a mileage log. To back that up, you need to have a calendar where you have everything notated, where you went, who you were with, and that is backup for that. The IRS does not accept credit card statements as the receipts. You need to keep your receipts, okay? Supplies, count everything. Equipment depreciation. After September the 27th, 2017, it's fully deductible. You no longer have to deduct it over 5 or 7 years. Again, that's a strategy on how you're going to apply those deductions. Your rent is totally tax deductible. Now, if you have an office at home, many of us do, you can keep track of all of those expenses. You keep track of everything that's done to the house. You keep track of all your utilities, and then you can count a percentage of your designated office space, and that's tax deductible. Legal and professional fees, all fully tax deductible. When you meet with a client or a prospect, 50% deductible on your taxes. However, if you go to Huntsville, if you go to Dallas or Galveston, that's 100% deductible. Your travel and lodging and meals. Interest on business debt is fully deductible. Qualified business income and contributing to retirement plans. All of those are strategies that need to be figured out for your specific business. So as we wrap this up, remember that what you save on taxes is not just tied to an income number. You have to consider the deductions on how your business structure is, and other strategies. And as you plan, knowing what business structure is the best for you, you have to look at your cash flow. You need to look at how your how much control you want to keep and how much control you want to give up. And those kind of decisions can only come from professionals that are in the industries to help you. So for those of you who are watching on MACC University right now, I hope you have enjoyed this. If you have any other questions, my phone number and email address are on the screen, and feel free to contact me. And so at this time, I'd like to open it up for any questions.
Somebody else may have the same question as you. None, we've got this down. That was amazing presentation.
You all will think of questions later.
Yeah, absolutely. Well, what an
Yes.
amazing presentation. I learned a lot.
Good.
Nothing?
Well, I hope that I have spurred some questions, that you have a lot of things to think about. And I highly encourage you to contact your attorney and your tax professional, your financial professional, and all work together.
Thank you so much.
You're welcome.
That was fantastic.
That was very good.
Yeah, we enjoyed all the history and understanding perspective. You know, that's so important for us to recognize where we are in this moment in time.
Right.
Because sometimes we just get all consumed. And then considering all of the different deductions, you know, we feel like that's a moving target
Sure.
as business owners. You never quite know. And sometimes we feel like that's by design, that we're not meant to go.
Right. That's true. That's
Right?
true.
So I appreciate your wealth of insight. You've got a lot of resources and people around
Yes,
you
I do.
feeding you with information. So
Absolutely.
questions are always coming to mind at random moments.
That's right.
When we have to deal with them at that moment.
Mhm.
So we will have Kim's information posted at the end of this video, and you can contact her directly. And if you have any other questions, please direct those to her or contact the chamber office, and we'll get you connected with Kim.
Right.
And she has a heart for educating us,
Absolutely.
and I love that. Yeah, you would give that. Thank you so
You're
much.
very welcome.
All right. Well, thanks guys for coming
Yes.
today. We appreciate
Appreciate
it.
it.
And thank you, Michelle, for letting us come.
Yes.